the market expectation in this current market is fully upgraded. We're not always there traditionally over the last 25 years.
What would be like a cheap house hack to get the property at the highest valuation?
Lack of inventory is caused somewhat by the higher interest rates. People aren't so happy to get off their 3.5% mortgage.
Hey friends, today I'm here with Charles Siebrecht, who is a local real estate appraiser here in Palm Beach County. Charles is a second generation real estate appraiser, and he's been appraising himself for 36 years. And really awesome guy. We're going to get a lot of value out of him today. We're going to be talking about housing trends. We're going to be talking about appraisal rebuttals. We're going to be talking about what he's seeing in the market from a valuation perspective that you can give to your clients if you're a realtor or if you're an investor or a homeowner. Just great information that you can take with you. And we're also going to be talking a little bit about, what makes a good investment, what factors into property values, and, where you can get the most bang from your buck. And we're going to get the crystal ball prediction for 2024 from this guy. So, but what I love about Charles is that he's a family man as well with 4 kids, beautiful wife. So welcome, Charles.
Thank you for having me, Ryan.
Thanks for coming in. So just real quick, just to tell me just a little bit about yourself for people that don't know you, and a little bit about your journey into appraisals, and we'll kind of dive into the market.
Fantastic. Again, thank you for having me. I was born here in West Palm Beach in Good Samaritan Hospital. I'm a second generation Floridian, if you will. Since the 40s, my family's been here, always involved in the real estate industry. My father was a feasibility study for developers here early on, and I've carried the torch, so to speak, in appraising since 1987, actually, when I started working for him. So I've seen a lot. We've seen a lot of market changes up and down, and we've kind of have some experience with what we're going through now, and happened to be a real estate broker as well. When I started appraising, it was a function of the real estate license. There were no certified appraisers, so I've always sold real estate as well. So I'm a little different appraising that way because I have a brokerage perspective that I can bring to the table too. So a little more keen on market interactions between buyers and sellers than most black and white appraisers.
Yep.
But this is why, as you know, I do a lot of appraisals for realtors pre-listing to get a feel for what the expectations for their sellers should be.
Yep.
I guess we're here today to talk about what's going on and what we can expect in 2024 since we're nearing year's end. And,
yeah, let's talk a little bit. Let's kind of like dive into some of that stuff. Given current market trends, what are you seeing right now as like what's affecting property values? Like what are some of the biggest things affecting property values with the market trends right now?
Well, it goes without stating interest rates have a big effect on it. We've seen market times increase. We do a pretty good market study in every appraisal with respect to the expected market time for a property. And I think you can attribute a lot of the extended market times to higher interest rates in certain price points,
yep.
Obviously. But that's one of the things. Lack of inventory is caused somewhat by the higher interest rates. People aren't so happy to get off their 3.5% mortgages. So
yep.
Everybody's holding, which causes a lack of inventory, which causes price to stay stable.
Yep.
So while we're not seeing much of a decrease in value overall for Palm Beach County yet, I say yet, but hopefully not. But if we keep seeing extended market times, we're going to probably see some sort of reaction from sellers.
Are we starting to see a buildup of inventory now, or it's still?
We're not seeing
pretty low.
Supply is still very low, but buyers are even lower. Is the equation I see so far. Yeah. That results in the extended market times. At what point we see sellers caving and trying to chase the market to find that buyer, We're not there yet, but hopefully we don't get there. So prices remain stable.
Yeah, it seems like when rates kind of peaked at that 8% level, like a lot of people put the brakes on. That was a big psychological number, I think, for a lot of people. And that's kind of has been towards the end of this year, and where you're seeing a lot of people say, hey, let's hold off until next year. They're hearing all this talk of like the Fed lowering rates. So like, let's wait until early next year, see what happens with rates. And so I think, this, holiday season, we're seeing a little bit of a slowdown in inventory buildup. Would you say like right now is a good time to buy in the state of Florida?
Well, I think there are pockets that are certainly good times to buy. Florida itself, I think, has to shake out a little bit of the insurance problems we're having. I think that's going to be something that will make buyers feel more secure when we wrap our arms around some sort of stable rates in the insurance market. Yep. But overall, I think it's a good time. It appears we're going to have quite a bit of a big business moving into South Florida and Miami, especially this South Florida market, which is certainly going to help. I think I don't expect us to see a decrease in market value that you may see in other areas across the country. That Florida traditionally hasn't had an economic base; it's always been a quasi-retirement base or service industry based.
Right.
That's about to change, it seems, with the scuttlebutt that's out there. And I'm actually excited to see what that brings to our economy.
Yeah, they're saying, like West Palm Beach is going to be like the Wall Street of the South. All these big financial institutions bringing in employees that are, really high-paying jobs. So it'll be interesting to see how that all shakes out. Have you seen any like any trends in real estate? Like when you're out appraising homes and analyzing the market, have you seen any any new trends as far as like two years ago, like during COVID and even post-COVID, like Airbnb short-term rentals were like the big rage. Like everybody was buying short-term rentals. Have you seen any other emerging trends that are happening right now, either in maybe property uses or property design or anything like that?
That's a great question, and I think that probably will end up being a market factor in what we see with some of these middle range houses. I did hear some analysis on the Airbnb market softening tremendously. Yeah. And at what point will those owners get into a sale scenario, or will they be able to weather the storm at an annual income, rental income? Will that suffice with the debt service they have on the properties? Right. We may see quite a few of those properties come on the market, and I'd be interested to see. That's one of the few things that may affect, I don't like to use the term lower price values, but the 5 to $1 million houses in Palm Beach County. A lot of those were absorbed. In my mind, a lot of it was irrational. There wasn't anything attached to it, like near the beach, or it was just random west of 95 Airbnbs. And the demand for that will be the first to go. And I've heard some people trying to analyze that market. It's going to be sticky.
It's interesting how, like, from a real estate appraisal standpoint, when we request like a 1007, say somebody's buying an investment property, the appraiser is analyzing the comparable rents that you would find on MLS, primarily MLS, because it's not public recorded data. So the issue there is like, if somebody's doing a short-term rental and there's no data, you just have the MLS data for annual rents. It's like, how do you truly give a valuation? Like if this is being analyzed as a short-term or used as a short-term rental, maybe the best use of it is a short-term rental because it has a nice pool, beautiful backyard. Like a long-term rental and it's furnished, a long-term rental is not really going to make sense on that. A short-term rental would. But from an appraiser standpoint, like has the appraisal industry and appraisers like caught up and been able to get those data sets where they can properly appraise properties based on short-term rents?
Well, you bring up a great question, and it's come to me often. The homeowner hands me a full Airbnb, portfolio of what is produced over the last year. The reality is, until the banks, the banks want me to find comparable data I can't do it. So if I can't do it, then the bank doesn't want to lend on anything other than what I can get reliable data on, which is annual rents.
Right.
So until lenders are willing to take verbatim a spreadsheet on what's happened over the past year on this particular property, I don't see it changing. The term that is used is it becomes a business valuation after that. If you're looking at the Airbnb part of it, it's not a real estate appraisal.
Right.
It's done on a commercial basis rather than a residential. So
it seems like there should be some like software or something to like really streamline that process. Because moving into the future, this is just going to become more prevalent, and so eventually, I'm sure it'll catch up. I know in some communities where short-term rentals are allowed, like condo hotels, things of that nature, you have the data sets from the property manager, so in that case, you have the data.
Correct.
But just on your standard single-family Airbnb, it's hard to really get those data sets. There are websites like AirDNA, but it's not like really a perfect data set like MLS would be.
Well, and as those databases grow, maybe lenders will be more inclined to let me use that data. But the volatility is a little too much right now for them to stomach, I imagine.
Well, what are you seeing in design trends right now? Like, what are clients looking for?
Interesting.
Because forever it was like they want the white kitchen. It's like the white and blacks or the white and grays. Is that still like all the rage, or?
It seems to be the rage still, and there's two things in the appraisal industry that I've known have been going on for years and not been able to really document. The other thing besides the interior features in the white quartz and the white cabinets, that seems to be still prevalent, even with the new construction and redos from 5 to 7 years ago. The other thing that seems to be fading is the desire for Tuscan Mediterranean style homes. Hard to quantify it, but the contemporary Bermuda, West Indies style homes are certainly the ones that are in demand. And even to the extent that I've had a multi-million-dollar owner hire me to determine whether to tear down her house, 11,000 square feet, or to spend $5 million taking the Tuscan out. And she spent $5 million on a $15 million home taking the Mediterranean out. So it's a real design and appeal. It's just not measurable for me to make that adjustment on a smaller home, but it's out there.
Yeah, a lot of people really like that Mediterranean style for years and years, but yeah, now it's they're not really liking that. And I have been seeing some styles where they're bringing in like more of like the wood or the light woods into the kind of to mix up the lights and the grays. What about the when you're looking at like a valuation, say of a new house versus an older house, maybe that's like 20 years old. How do you make adjustments based on that? So like right now you're seeing a lot of like tear downs on say the intercoastal or in certain neighborhoods where, it's a great neighborhood. Maybe it's, the location's amazing and it's all a bunch of old homes from like the 70s and 80s. And so now you're starting to see the tear downs where people are ripping it down and they're building a new house. So if all the comps are older houses, like how do you compare those to say a brand new construction? Because the new construction house, obviously, you have ceiling height and you have all the other features that are different than they were 20 years ago.
Great question, and it's forever going to be a pickle for appraisers during the transition phase. As more comparables get torn down and are rebuilt and resold, it becomes easier. But you're absolutely correct in the fact that you can't make high ceilings out of those low ceiling homes, and this is a pickle. You also have the government influences, which is you can only redo X percentage of your house before you have to raise the elevation of the house to meet the new HUD flood standards. So there's only so much you can do within the constraints of the government to make this house more modern. So I think that's one of the reasons you're seeing more tear downs in high land value areas. It's fascinating to me that it's actually doable. And not so much, I'm just old school. You don't want to be the first one to go out and put that new home up, right? I mean, that's going out on a limb. When it becomes a trend, you can't deny it. But for me, the early ones are going to be problematic.
So when a real estate salesperson is going to comp that house, so let's say that guy's building it on spec. You know, there's no comps in the neighborhood. Like, how do you comp that house? Are you going to like take an adjustment from the older homes in the neighborhood, but then find a new construction, say, even if it's a ways out, like in a different neighborhood, different area,
Certainly.
make adjustments?
Certainly. We call it a blend of comparables. And when going to those external projects, you have to be careful of the fact that those are consistently 1.5 million homes over and over again, new homes in the neighborhood. You're not the one out on the limb hoping this thing flies. But the key component is when doing that, we'll try to stay with something with similar land value. You know, you speak of some of the old downtown desirable locations we have here in Palm Beach County where people want to be next to City Place, but there's an old home. The reality behind that is land values are high, desirable, so it's worthy of doing it. And there's a subliminal effect on an appraiser that you understand this. And if you have a high land value, it's easy to go to a neighborhood with high land value new homes and make the comparison. At the end of the day, and I find it hard to believe that a lot of realtors come to me and say, "Can I give you some comps?" Because at the end of the day, they're the experts in that area, and I should be listening to them most of all. But I always tell them, where would you take a buyer for this house? You know, would you show them, they're telling you they want new construction, that is the comparable pool I should be drawing from.
Yeah.
When I go find.
So that's actually a good question. So for a real estate salesperson, when you're meeting an appraiser at the property, do you give them comps? Do you give the appraiser comps, or do you don't give them comps? What's your advice on that?
You absolutely give them comps. If they don't take the comps, I can't speak for those appraisers. I know they're out there that won't take them, that don't want to be influenced. For me, I'm not influenced. I'm happy to have them. Again, I travel from Boca Raton to Port St. Lucie doing appraisals. You farm El Cid.
Yeah,
you're the expert. Why wouldn't I want your comps? And at the end of the day, that's my job.
Right.
To listen to you. I'm going to have to call you anyway to find out about a sale you did next door, to find out the terms of the sale. Why would I not want your comps up front? I saw some data from NAR, the National Association of Realtors. It was a questionnaire. They questioned realtors about their interactions with appraisers. I think 40% of them said they just open the door. Right. I was shocked.
Yeah.
Frankly, I was shocked.
It makes sense. And also, what about a list of upgrades or repairs? Because you don't necessarily know exactly what maybe the seller has upgraded.
Mandatory. In fact, I love it. It's a good marketing material anyway. They can upload it in MLS under documents.
Yep.
It gives me a head start on the appraisal when I'm pulling my comparables. Benefits the buyers. It's absolutely. I would simply ask them to ask their seller to give them a breakdown of what years each item took place. It's a great tool. Some are done so well that I'll incorporate it in the appraisal, as opposed to me handwriting out or typing out all the upgrades. There it is.
All right.
See attached upgrade list. Justifies supports my adjustments.
What would be if I'm getting ready to list my house and I've been living in it for 5 years, nice house, maybe I renovated it like 5-7 years ago, but I'm thinking about listing the house. What would be like a cheap house hack to get the property at the highest valuation? What can I do as an inexpensive house hack to get the highest value when I go to list my property?
That's a great question, because there's a fine line in today's market. The market expectation in this current market is fully upgraded. We're not always there traditionally over the last 25 years. There's ebbs and flows. This particular buyer today typically doesn't want to tackle upgrading. But a quick hack to your point or your question is, It seems kitchens and baths are the deal. We've also seen a crazy change in the market where houses without pools are really hammered. It used to be, give or take a pool, or we'll add a pool. You almost don't even get a buyer looking at you if you don't have a pool these days. And it's something that's new. It's happened over the last 4 or 5 years, even since COVID. I think flooring, kitchens, and baths, even if you can only do the master bath in the kitchen,
Yep.
It's the way to go.
Let's talk about pools. So, that's always a question, that realtors will ask, like, well, how much value is the appraiser going to get for the pool? Or they'll look at the appraiser report and be like, man, this is crazy. This appraiser only gave a $20,000 line item adjustment for the pool. So, like, is there a standard valuation you give for the pool? Obviously, you have to pull that from the data sets. But, like, how much value does a pool give when you list a house?
So this is something that has changed in my mind. I can only speak for myself as an appraiser, but this is where I find it good to be a broker as well. That standard you speak of, the pool appraiser is going to give it 20 grand. That 10 years ago, that was the deal. I mean, appraisers just were lazy, what have you. But if you look at sales with and without pools now, you'll know that in $1 million market, that pool is worth more like $125,000. I mean, even though it may cost $80 to build, they want it there. And at the end of the day, I think people lose this. The appraiser's job is to extract, if you will, the market reaction to a particular item. And I can tell you that market reaction has gone from I'll give or take a pool, I'll add a pool if I want to it needs to have it.
Right.
So that 20 grand to I'll give $1 million house 100 grand sometimes on a pool because it's expected, because the market's telling me that. But
so it would make sense if you're in that market, maybe you're like, north of like 700. If you're in that market and you don't have a pool, you would probably get a dollar for dollar return on your investment for a pool, like in that higher end market, right? Versus lower end, you might not get I mean, if you're putting an $80,000 pool in a $300,000 house, you're probably not going to get a dollar for dollar on something like that, right?
Correct. And then that's where the market tells you whether it's an expectation for the million. For the $1 million house, it's expected to have the pool.
Right.
And so it's worth it to do it. And you bring up a great point on the dollar per dollar. Two things that have changed over the last 15 years and that I've seen is upgrades, you're getting 100% return on. You used to be, in the old days, you get 50%, 50 cents on a dollar.
So you're talking like new kitchen, bath, stuff like that.
Right. You never get the full return. It's expected now, but the market has changed. And so you get 100%, sometimes more than 100% on your return, especially these condos. These condos on the ocean where you have to do an elevator, you can only work certain hours, you can only work certain months.
Those properties are sitting.
They'll pay double if you have it already upgraded.
Yep.
It's just reality. And again, I go back to it, but it's my job to extract what the market reaction to these things are, not to do a dollar per dollar thing per se, but that's real. The cost of money and time make those condos.
100%. Yeah, we're seeing that. I mean, we're seeing that with our clients too. Clients want the fully upgraded house. They want everything. They don't want to go into a house and have to redo everything unless they're buying it for investment. But for the most part, if you're moving your family in there, they want the upgraded house. Those houses are gone.
No question. And I'll tell you from your standpoint, and you've seen it with your underwriters, in the old days, there was this kind of blanket rule whether you can only make a line item adjustment for upgrades 10%.
Yeah.
I'm making huge upgrade adjustments, and underwriters get it. They understand it because it's the market. All I have to do is explain it. Well, it reveals itself in the sales.
Yeah, you can see the sales.
Right.
It's very clear, though. Right. The homes that are upgraded are selling for big numbers, and they're not staying in the market very long.
And you'll see right now the market that's starting to get squeezed is this $1 million to $2 million market. And the reason it's being squeezed is the people that are going from that have the money from $1 million to $2 million are often cash. They're buying new construction at 2.5. They don't care.
Right.
They want the new construction house with the new finishes. So you're getting a void for those resales in that $1 million to $2 million range.
Right, and the buyers for that are currently in the $500,000-$600,000 house, sitting on 2-3% mortgages, and they're like, "Listen, I really want that $1 million house because it's in the better school district, it's closer to work, nicer amenities. But listen, I'm not going from a 2.5 to a 7.5. But when rates start to come down, like, what is the number that's going to trigger that guy sitting on the 2.5-3% loan to say, okay, if I can get the 4.5 or if I can get the 5 mortgage, I'll release all the equity in my house, put a big down payment, and my payment's maybe going to go up just a little bit if I go same loan amount here on the same loan amount in the new place." So it'll be interesting to see as rates drop, like, what is that sweet spot where it's going to start to trigger people, and then you're going to start getting that fear of missing out because all these people are going to be like, okay, they're going to start buying homes. So you're going to have a listing now, so you're going to have more inventory, but then you're going to have way more buyers. So it'll be interesting to see how that shakes out. Like, will it be a case like we had a couple of years ago where it's like you have all this buyer demand, multiple offers, or will it be that, but also a lot more inventory because these people are now listing their houses?
Great question. And the question about, you're the first one, Ryan, that I called when this started happening last Thanksgiving, I believe. And I asked you, when are we going to come up with an adjustable product? Remember that?
Yep.
Because I thought, well, gosh, if we can get some people in the 5.5 range, we'll get them to pull the trigger again. And from everything I've heard from some of the experts, it seems to be 5.5 is the number. Exponentially, when you're increasing the size of these loans and you're in the $1.5 million range, that means something. It really does. From 3.5 to 8 or 7.5, it's just not. And I've had buyers just saying, well, I pulled the trigger if I knew I could get out in a year, but
right.
And these buy down tactics, if you will, buying a mortgage down, they're good for 2 years. You still have to qualify at the higher number,
right?
And I don't see the back room work where you have the debt to income ratio, how that affects it. But
yeah, we're seeing some buy downs. That's basically where, like, let's just say rates are at 7% or 6.99. If we do like a 3-year buy down, we can get your first year interest rate down to like a 3.99, which is great. Second year jumps up to 4.99, 5.99, and then 6.99 to finish out the 30-year loan. For those buy downs, basically you have to get a large seller credit, and then that credit then goes towards the cost of that buy down. Basically, if you think about it, what's happened is the seller is subsidizing your rate for the first 3 years of your loan. Concept there being that if you can refinance within those 3 years, then you've won. Because if your rate year 1 was 3.99, year 2 4.99, and maybe that's when you refinance, then you refinance into like a 5 or 5.5, then you've saved all that. You never really had to pay a 7% loan. And whatever is left over in that kitty, that subsidy account, you get back. So the buy downs are great. The pushback I've seen on those buy downs is that it's a little confusing for the seller. The realtors don't know how to explain it. The buyer, it's a little confusing for the buyers. But if you can get everybody to understand it and explain it, give them the literature, go through the charts, show them how it works, it's a great program. But some people just can't wrap their mind around it. And sometimes it's hard to negotiate a large seller concession. You can't quite get as much as you want. So those are the kind of the pushbacks and the buy downs. But I agree with you. I think, once rates go into the 5s, I think that's where you're going to see a lot of people starting to run numbers. And then what's going to happen, I think, is like as you start to see, more demand, you're going to start to see more people kind of jump on the bandwagon. And then it's just going to probably take off.
I agree. And that will be only bolstered by the fact that we have industry coming to South Florida.
Yep.
Those factors should create another demand again. And Florida, let's face it, it's a great place to live. I mean, it's always been that way.
Yeah, I mean, it's a great place to live. It's becoming more, obviously more expensive than it used to be. But, with no income taxes, palm trees, I remember when I moved down here from Michigan, 20, 25 years ago, I was like, well, I can always go back. Never went back.
No.
palm trees and sunshine, and yeah, it's a great place. It's a great place to live. So, you can't blame all the people for moving down here. I had a couple other questions. What, some in Florida, primarily a lot of the homes are built concrete block construction, because we have hurricanes, of course. But some homes are built with frame. You see that a little bit more in the north. What would you say the biggest difference valuation-wise? Like if you have two houses sit next to each other, same location, same lot size, same size house, etc. One's concrete, one's wood frame.
Always been a question. The answer varies, and I'll tell you what dictates it. And I've watched it and documented it over the years. In a period like we just came through with COVID, where the demand was high, there was no difference.
Didn't matter.
No. But when the inventory gets high, you almost can't sell a frame home. It's that black and white. And
yeah, because if they can get the same house in block, for the same price or similar price, then yeah, you're going to go block.
Absolutely. And the funny thing is, I think some of that's subject to the realtors' excitement, if you will, over this. They'll play it down when there's no inventory, and that is the house that meets your buyer's needs. They'll play it down, and if there's plenty of inventory and they can find you the antidote in CBS, or concrete block, they'll take you there and be more excited about that one. It's all inventory driven, and it's very similar to upgrades. When the market's good, people pay exorbitant amount for the upgrades, and when if the market gets, the inventory grows, you're going to get those upgrades at a discount. It's always been that way. But frame, since they've introduced hardy board siding, which most homes are ending up with hardy board sidings, seems to be just a little bit less desirable than CBS.
Gotcha. And have you seen, the big rage out in Texas and a bunch of states across the nation are these barn dominiums? I don't know if you've heard of these things, but it's basically like a farmhouse style, like a modern farmhouse style. They started with, these steel barns, where you can get like a steel constructed barn. I mean, even in Florida, like you can get them like literally like hurricane rated, the whole 9 yards. And you can get, similar to these. So you can get like these steel barns. And then what people started doing is converting them into like living quarters. I've had a few clients ask like more like St. Lucie, more a little bit north, but have you seen any of these pop up yet?
I have run into a couple of them, as you say, in St. Lucie Farms, Palm City Farms in Stewart. And they're really desirable. People love them. If you're on 5 acres, that fits the bill, as opposed to dropping a Bermuda-style, West Indies-style home in the middle of 5 acres. It's almost out of place, whereas this is more in place. And the features, as long as the features on the inside, which they are similar to the West Indies homes and the modern expectations, people love them. And they're steel. Yeah.
And so how would a valuation be for that? So if you have a wood frame house or you have a steel frame house, like, is there a difference there? I mean, a steel frame, I would assume, is a stronger.
Well, it depends on whether you're asking the realtor, Charles, or the appraiser, Charles. So from the realtor standpoint, there's not much difference. You'd rather have the steel for sure than a frame, and to be more desirable. From the appraiser standpoint, I go back to it. It stinks, but I've got to find another steel one that is sold to bolster my.
It's probably gonna be hard to find, right?
Darn near impossible. And
so then, would you compare it to a CBS more or a wood frame?
I may vet the buyer and see what their thoughts were on it, so I make sure my thinking is. And again, you talk to the realtor. I keep coming back to this. If you were a realtor, where would you take this buyer to show them alternate properties for them to buy, and what was their reaction? I'm looking for the market reaction, and I think a lot of appraisers forget that. You're looking for the market reaction for what you're appraising.
Right.
And not so much the cost to build or the cost of the upgrades. You're looking at what the market's willing to pay for. Because at the end of the day, if the bank takes it back, they want to know what the market's willing to pay for. They don't want to know what I think of the upgrades.
Exactly. Yeah. Yeah, it's interesting. It would be interesting to see if they start building more of these. I mean, I think they're beautiful, and online there's kind of a big rage right now.
If I didn't interrupt, I did a job for you along these same lines. That is, we saw this trend come out years ago about the overseas containers being turned into houses.
Container homes. Yeah.
I will tell you, I did a job for you in Lake Park, and it was 2 containers put together. I couldn't tell the difference between a regular CBS house and the house when I walked in it. It's that technology has it that fine-tuned to where you couldn't tell. But I know underneath it's metal, it's steel, it's not going anywhere.
That thing's not going anywhere.
But again, I don't know what the market reaction is to it. I mean, will they rather? I think they'll think CBS and that are the same.
Yeah. Yeah, I mean, container homes, as long as it meets like the Fannie Mae requirements, it has to have certain minimum square footage, et cetera. The biggest thing when it comes to a lender and financing a container home is comps. You have to have other container home comps, and that's always been the big issue. It's like having any type of unique property. Like Fannie Mae is not going to want the one container home in Palm Beach County because, if they go to sell it, it's like, who knows? Is there a market reaction? Will people buy it? It's like those old dome houses.
Sure.
It's like, who's going to buy a dome house? Like, how do you even comp that thing?
It's crazy. I've had them over the years, and I don't ever care to have one again. But if you're really looking for the market reaction, i.e. the bank, and I walk in there as the appraiser and I say, this looks exactly like a CBS, and I would bring a buyer here if I was the realtor, that's the market reaction to it. It's the same as a CBS. Why do I have to find another unicorn out in Wisconsin?
Right.
I'm looking for the market reaction, aren't I? If you take it back, what's the market going to do with this house?
Yep.
So I find that a burdensome task, if you will, from the bank.
What do you think? What do you think about realtors? A lot of realtors and homeowners, they always do not always, but a lot of times they'll do price per square foot. It's like, oh, well, that house is selling for, $350 a square foot, and that one's selling for $250 or $225. And so a lot of homeowners will base their numbers on like a price per square foot. But that's such a skewed number, right? Because you have like lot size. I mean, you have so many other factors. Could you explain why that's not a perfect science?
Well, I will tell you, this is a pet peeve of mine, and I love realtors' input and comparables, but when they come to me with circles around the price per square foot, it drives me nuts. As you say, there's too many different factors. There's lakefront, there's lot size, so basically an appraisal takes those things and itemizes them and pulls them out one by one. So your dollar per square foot that I'm using for the house itself is far smaller because those other things have been taken out of that big number.
Right.
So
you're just using the base, like living square foot part of the house, and then everything else, like your upgrades and lot size and view, outbuildings, blah, blah, blah. That's all
correct.
Separate.
Correct. And this is one example I use for, you're a realtor, you're taking a buyer to Jupiter Farms. Most of the lots are 1.25 acres.
Yep.
There's another house with 1.5 acres, and an appraiser makes an adjustment for the quarter acre difference. I can promise you, if I take a buyer to those 2 properties and they stand on the property and look at the house, they won't tell you which one's the 1.5 versus the 1.25.
Right. That's
the market reaction. An extra 10 feet down one property line on a 300, you won't know. So it's basically, I'm trying to figure out the market reactions of this thing. I can guarantee you if they're the exact same house and this one has a white quartz countertop, they're going to take that one because they don't care about the extra 10 feet.
Right.
So, the dollar per square foot thing is an overall nice feel-good thing when you're selling a client as a realtor, but appraisers dig in much deeper than that and take the extracurricular things out before they do the dollar per square foot in a house. And again, if you have a 3,800 square foot house and a 4,000 square foot house, I don't think anybody really would know the difference as they walk through the house.
Right.
I mean, that's just me. I mean, the finishes and features right now mean more than that extra 150, 200 square feet.
Right.
It's just reality.
Interesting. What about, kind of circling back to that whole dollar for dollar, upgrades things. One of the big things in the state of Florida, you talk about insurance, is roof windows. The big thing right now for insurance prices is the age of the roof. If the roof is older than like 10 years, then the insurance quotes just, start going up. So the big thing is if a realtor is taking a listing and they know it has an old roof, maybe it's 25 years old, shingle roof or 30-year-old shingle roof, they're advising their clients that, hey, listen, maybe we should replace this roof first and then list it, because they know they're going to get the value for it. Because, a lot of times a first-time home buyer is not going to have the extra money post-closing to fix up that roof. And then he's going to get his insurance quotes in. And they're going to be at like $6-7 a year. And he's like, I don't know if I can afford the payment now. So what are you seeing as far as valuations when you have a new roof in like hurricane glass or hurricane shutters? Because for many years, it wasn't that big a deal. Like if you had a new roof or hurricane shutters, like there really wasn't a value change, like maybe a little bit. But I'm feeling like now it's a much larger deal because of the cost of insurance. So have you seen that in the market?
Well, not only have I seen it, and it's funny, you make me think about this. Just recently, and I would say the last 2 years, I've actually been kind of almost line iteming roof age, because it's that big a factor.
It's a big factor.
I may lump it into upgrades, fully upgraded and a roof, fully upgraded older roof, and make an adjustment. This is a real problem, and it's insurance driven. How many times do you hear my roof's not leaking? Why do I need
I got a 40-year-old tile roof, never's leaked a day, and it's like a perfect roof, but the insurance company is going to drop me. I can't even get insurance. So it's a problem.
Well, as you know, I'm a governor on the board of Realtors, and one of our, I'm trying to. There's a My Safe Florida plan. I don't know if you've heard of it. It's a $10,000 grant for hardening your home windows or roofs. And we have a state senator who's on our corporate board. And I've told her, I said, why don't we bump that up to $50,000? Make it a little easier to obtain. Roofs would be doable beforehand. The market would move. Revenue would go up from dock stamps. You would come back. And they're sitting there right now. The state is, I believe, with a bunch of money in a co-insurance fund that they put up. And the co-insurance fund isn't enticing people to come here and insure.
Right.
But I think roofs would. So I'm almost inclined to have them send out a questionnaire, Miami Board of Realtors, to find out what percentage of engagements and deals have fallen apart because of roofs with realtors, to get some real data on how it's hurting from the tax revenue side as well. And if it makes sense revenue-wise to make that $50,000 instead of 10, so that things move and the tax revenue increases, it's a no-brainer in my mind. That seems to be what would entice insurers to come here more than co-insurance.
Right. I agree.
At the end of the day, the co-insurer is FEMA, right? Yeah. Because the money always runs out in a major.
Yeah, I mean, on insurance right now for your sub-$1 million homes, like we're seeing it has to be like 98% of policies are citizens.
That's co-insurance by definition.
It's a large percentage is the state-run insurance company. What about the hurricane glass? Because a lot of people, I want to put, new windows, hurricane, they're super expensive. I mean, you're probably going to spend anywhere from like 30 to like 70 grand to do your house, depending on how many windows, etc. But probably something like that, you're not getting a dollar for dollar return on it. It's more like peace of mind, or what do you think? What are your thoughts on hurricane glass?
It certainly has increased the return. Initially, when it came out, it was who cares? So I have accordion shutters or impact glass; they're the same as a piece of glass. The fallacy is impact windows break,
right?
So and they're expensive to replace,
right? So if a coconut hits your impact glass, it's still going to break. It's not going to go through it, but then you got to replace the window.
Exactly. Yeah. And so I'm supposed to look at the market reaction. Right now, it's damn near 100%. Excuse me. It's 100% return. It's really crazy.
On your higher end homes.
On your higher end homes, it's almost a market
It's expected.
expectation, like a pool.
Yeah.
And I find it hard to believe that we've gone there, but it's true. We'll see when the inventory picks up or what have you, if that's still the case. But there is an aesthetics aspect of impact windows and not having hurricane shutters and accordion shutters.
Right,
attached
it
to your
looks
house.
nice.
So I think when you get in that $1.5 million to $2 million range, you're not expected to have a slinky on your window.
And what do you think right now? Why do you think? Actually, let me rephrase that. Do you think at all prices will go down next year in certain markets in Florida? I mean, I think nationwide, maybe you see some softening. Personally, certain markets I think will probably soften that were overbought. When rates go down, that'll probably help out. But what do you think about in Florida? Will real estate prices go down in 2024?
A one-word answer would, my best guess is yes. Pockets, definitely. Some pockets, not at all. I'm seeing a lot. I don't know about you, but I'm seeing a lot of FHA buyers and a lot of FHA appraisals. This indicates to me that buyer is strong. The interest rate doesn't affect the $400,000, $300,000 mortgage like it does the 7 and 8 and jumbos.
Yeah.
Just strictly by volume, appraisal wise, that seems to me like it would indicate if there's going to be a softening, it'll be in that other range,
The higher end range.
Yeah, and I'm not part of cash deals. I can only watch them in my overall analysis of a market.
Yeah.
I do know from some of my listings that the cash buyer is a lot more hesitant than they were before. They're a lot pickier. They want it their way.
Yeah.
They're walking during inspection periods. They're just not strong like they were during COVID. That's just reality. Whether that reveals itself in actual reduction in prices, that's going to depend on the strength of the sellers soon. I just don't know if the economy is going to hold up enough to keep sellers strong to hold prices.
Do you think that so first-time home buyer markets are going to be probably strong? Because we're seeing that too. We're seeing a lot of first-time home buyers, people that are wanting grants, bond programs, or people entering the market. But then you have your middle market, like that 7 to like 1.5, and that's where you're saying we could see some softening, because really the buyer for that market is the guy with a $500,000 house that needs to sell. What about luxury, like 2 million to 15 million, like that 2 million plus market? Do you feel that one could have some corrections, or do you feel that's pretty strong still?
My father would have even said back in the 60s, if you are attached to waterfront, the moon is the limit. If you're talking about some of these massive equestrian properties, there's just going to be less buyers as a function of, it's always that those are always tied to the stock market.
Yeah,
they really are. And I've seen some illiquidity on buyers' behalf with regard to their stock market holdings cause deals to go sideways in the $15 million range.
And those are all cash.
And they're cash, but they're leveraging stock.
Right, so they're usually could be tied to prime, because if they're doing a line on their portfolio, you're probably going to be at prime, which is kind of spicy right now.
And there again, this is the buyer who's really savvy financially, and they don't make decisions that they're emotional to a certain extent, but when the finances don't line up right, they usually err on the side of caution. So I just think you have a few less buyers, but the sellers aren't in a pickle. So that market should stay strong, especially if it's attached to waterfront.
Right. Yeah. Waterfront just continues just to.
It's amazing
to, knock it out of the park. I was talking to a first-time home buyer this morning, and we were having the conversation, and he was like, well, I don't know, I definitely want to buy next year. We were just having like this general conversation. He's like, should I wait till rates come down? So I started to explain to him, I was like, listen, a lot of clients right now, if you're a first-time home buyer, find the house now. This is just my advice. Because right now we can negotiate a seller concession. We can possibly do a buy down. Let's just say we have to get a $30,000 seller concession. And what we'll do is we'll buy down your rate, or we'll pay for all your closing costs, or we'll ask for upgrades, or we'll do different things that we'll negotiate a great deal. And yeah, your rate's going to be high right now. But let's just say you take an FHA loan, 3.5% down. You negotiate a great deal. Let's just say the rate's 7.25%. With FHA, I can do what's called a streamlined FHA refinance. So this fall, when rates go down, let's just say they go down November, December of 2024. When rates go down, I give you a call, say, listen, you're eligible for a refinance. The rate went down over 1.5%. I'm going to send you some paperwork to e-sign. We don't need an appraisal. I don't need any income docs. I already have your servicing history from the loan that we're servicing. We don't charge any fees. You do have to pay the doc stamps and intangible tax and update your title insurance policy. But other than that, there's not a lot of cost. So it's like, we can always lower the rate, but like get the house. Because like once rates go down, all those people that we talked about earlier, they're going to be in the market. Mm-hmm. And a lot of the people that have been sitting on the sidelines, the first-time homebuyers waiting for rates to go down, they're now going to be in the market. Because think about it, like if we pre-approve you, say for $350,000 at a 7.25%, if rates go down to 5.25%, now you qualify for $400,000. So your whole pool of homes changes.
Correct.
So you're gonna have all those people you're competing against. So that's my advice: is like, listen, if the timing is right, the payment works, and it's the property you want, get it. We'll adjust the rate later.
I like that thought process, and I really like it because right now, while you have sellers experiencing a longer market time, you should be able to pick up the house you want.
Yep.
Without fighting, as opposed to the frenzy that was going on before, where it was 1 or 2 days on the market and people were overbidding and you were losing and frustrating. We went through that. Get the house you want now.
What would be a good way for all my real estate friends out there? They're working with, let's say they're working with a online lender or any lender, a bank lender. They listed a property. They have a buyer, they wanted to use their bank, whatever. So they're under contract, appraisal comes in. The listing's for $1 million. The bank appraiser comes in at like 900. There's clearly comps that support. They feel like, the valuation isn't right. The buyer's agent, the listing agent, everybody feels like the value is just low. What is the best way to rebuttal an appraisal? Obviously, you have to go through the lender, but what would be the best way to structure your data in like a clear and concise way to provide to the lender so they can upload it to their appraiser for review, to have them at least consider looking at it?
I will take you back to your earlier question, should I take appraiser comparables? If you've done your job properly as a realtor, you should just be uploading the same comparables you took them, right?
Yeah.
But the best way to rebut it is to not get into a fight with them. Don't call them. Don't do anything. Simply get the best comparables with the least amount of differences in the homes that support your value and upload them with a non-toxic. My experience with this is these guys. I don't understand not addressing it, but I know some appraisers just flat out won't address it. I will. I'm not afraid to say I messed up or I overlooked something. And I think there's a little bit of a fear on appraisers, like maybe my license is in jeopardy if I say I missed this or that. That's not the case. But the reason I say to take comparables ahead of time is for just this, so that the appraiser knows you know. Right?
Exactly.
And now when it comes back in the form of a rebuttal, it's the same comparables. I mean, you may or may not win this battle, but what are you seeing on the ability of lenders to allow you to get a second appraisal?
Very, very similar. So if the value comes in low and the appraisers feel that, A lot of times, listen, first off, I've been working with the same like 4 appraisers forever, you being one of them. So I have like really the best of the best appraisers, I feel. They're very professional. They've been doing it, all for over 15 years. So they're really good. So I know my pool of appraisers is good. So I rarely have issues. And if the value comes in low, usually everybody knows it's going to come in low. It's not a big secret.
Right.
So it's not a shocker. Plus the appraisers that I use, if the appraisal's coming in low, they make the call to the listing agent and the buyer's agent, usually the listing agent, and just ask them like, hey, listen, I'm not getting the number. Is there something I'm missing? How would you come up with this number? Like, are there comps off market? And then usually that's not the case. I mean, usually there isn't any other comps, and they just kind of shot in the dark on a number. And but sometimes there are additional details. So from a rebuttal standpoint, if everybody feels that the valuation isn't right, then I agree. It needs to be a non-toxic email, fact-based, not too wordy. Don't send 20 comps. No. Like, you send like the Flex MLS link with like, all these comps. No, don't send that. Send 3 comps. 3 comps, 1 being the best, 2nd being the second, 3rd, it's going to take you a little bit of time. Put your notes in there. This one just closed last week, or this one's closing, tomorrow, or, this property was a distressed sale. This was a divorce situation. We had the data to prove it. You got to come up with some data that the appraiser can sink his teeth into to adjust the valuation. Sometimes you have realtors that don't understand adjustments as well, where they'll see a comp that closed at, $1 million, and maybe our sales price is at 900. And they're like, oh, well, it's very similar, but then they didn't, they don't realize, okay, well, that lot was much,
price per square foot.
Price per square foot. Yeah, they go first. but they're not taking into effect the adjustments. And then when you start adjusting your subject property, it's like, well, the actual number is lower than our sales price. Right. So there was a reason we didn't use that comp. And if you actually read the appraisal report, and you'll see in the notes, the appraiser actually addressed it. I did not use this comp because X, Y, Z.
Exactly.
So my advice is to read the entire report and all the notes, and then do something clear and concise, 3 comps max, a couple bullet points, and see where it goes.
Well, and I will tell you one other trick for realtors out there. There's a very easy property appraiser site search for things that didn't go MLS.
Yeah.
If you don't take it for granted that there's not a good sale for your ammo, if you will, sitting there waiting for you to use that just didn't go MLS, that the appraiser couldn't use because he couldn't verify.
Right.
Maybe you can verify it. Maybe you knew about it because this is your farm area. Again, this is your expertise. The appraiser's running from Boca to Port St. Lucie. That should be one of your first places to start.
So as long as the private comp that's sold off MLS, you can verify it. So what would be the verification that an appraiser would need to verify that so they could use that in the valuation? So
the appraiser needs a conversation with the buyer, seller, title company. HUD is unbelievable. But he needs to at least speak to somebody who was party to the sale.
Got it.
If it was, a lot of times a realtor, I sold my neighbor's house off market and it's not showing up. Here's the papa. Well, you're a party to the sale. I'm done. I've got a good comp.
And you can probably get the HUD if you needed it for additional documentation.
Sure. You almost don't even need the HUD at that point because you've talked to somebody who's a party to the sale. You've gone on the tax records. You've seen the recorded deed for X amount of dollars. So we shouldn't overlook that. I start there as an appraiser. I start with papa and I pull the last year's sales in the subdivision.
We were talking earlier about estate sales, and one of the things that families don't think about, let's just say your parents have owned a house in Palm Beach for the last 40 years. They probably bought it at a really low price. Now it's worth like a ton of money, but they've been living in it a long time as a homestead property. Well, their taxes as a homestead property are capped at 3% per year. So over time, the tax bill remains relatively low compared to the true taxable value if it was on the market today. And we were talking about earlier is that, one thing that the heirs aren't expecting in these estates is like when they pass away and the property then gets transferred to the heirs, all of a sudden that triggers a reassessment. The homestead is taken off the property, the tax bill gets reassessed at current market, and the tax bill goes from like $5,000 to like $30,000, overnight. And we were talking earlier that, you've seen this, in these estate sales where the heirs are like, listen, I'm not paying those taxes, so I'm going to sell the house. So have you seen a lot of it, like estate sales in situations like that?
Far too often. And I always get the same story from the heirs. Well, my parents meant for us to have this house, and we can't have it now. It's a little frustrating in that the homestead exemption is wrapped up in the guise of save our homes. That was the verbiage that was used, or that's actually the name of the bill. The Save Our Homes bill was 3% tax increase a year. And it does anything but save our homes in that scenario, even though it's family members. It's a little frustrating. And on top of that, look at the tax base increase for the county. I mean, there's been a lot of tax base increase. I'm a little leery of where that money's going, but it's a different story, a different day.
Exactly. And the last thing I want to talk about, just for my real estate friends out there, is that market condition addendum in the appraisal report. And you and I talk about this, but I think like a lot of realtors don't use this, and it's part of like the flex. And I just think it's a really good tool to show sellers, and it has such great data. And this is located in the appraisal report. It's also, you can find it in the flex system. But can you explain this and how a realtor can use this to their advantage when talking to buyers or sellers?
A great tool for realtors to use, and it's the CMA. It's under the CMA button on Flex MLS, and you can pick the type of report. This one is a full market analysis, and then once you move there, there's a check mark you put in the 1004 MC form. This gives you a quarterly breakdown of the median sales price, the average sales price, of the sales. It also gives you the active listings during those 4 quarters, and shows you the trends. Now, this is basically statistics 101. It's data in, data out. You have to set the parameters for your data pool, if you will. And if your data pool, if you're looking for homes in generic neighborhood and there's 30 that pop up, well, the data should be fairly good, but it'd be better if you can get one expanded to produce 60 output. That being said, you don't want to include 1,200 square foot houses with 3,000 square foot houses. It's going to make everything look a little crazy. So what we're doing when we're doing that is we need to know, I'll have 60 in my first one because I need enough data to show that the sales prices have stayed consistent. That tells me whether the market's increasing or decreasing. That's what the bank wants to know. I'll dial it down and deal with 13 or 14 as a pool when I get to right around my house sales price, because I want to see where I am relative to the mean sales price. But the most important thing that I think right now a realtor can glean, which can help you with your client's expectations, is the days on market. It's been increasing. It's factual. You can tell them, your clients, to expect this, but when you show it to them, it just carries more weight. I think it's a really valuable tool, and I have to do it for every appraisal, but from a realtor standpoint, it's really good.
This Fannie Mae 1004 MC, right?
Right. Market conditions.
Yeah.
MC.
Yeah, it's a great little tool. And then lastly, a lot of the analysts, some of the data reports that we get, they're anticipating, they're projecting home values to increase about 5% next year. What is your crystal ball prediction for, let's just take Palm Beach County. What's your crystal ball prediction for house valuation for 2024?
I think a really good scenario would be that it stays stable, honestly. I just hope we don't have any kind of retreat. I'm not, for me, there's too much noise in the economy and noise in the political world to make anybody feel real comfortable right now. That coupled with the expectation that rates are going to come down. I think you heard a little scuttlebutt about the Fed maybe dropping sooner than before. If that happens, I think we will see a little bump up to 5%. If it happens in the first quarter, otherwise, I think you can expect the increase to start taking place next year, 2025.
25, yeah. So maybe 24 is a stable year. If rates go down towards the end of the year, and then maybe that pushes values up in more of a frenzy into 2025.
Yeah, and some of the big real estate players are already talking about that being the case. So I don't know. How quickly, I would ask you a question. How quickly does the bond market and the mortgage rate react to these governmental drops, the Fed drops?
So the mortgage rates are more tied to like inflation data. So when you see the Fed start to signal or even say we're going to start lowering rates, that's an indication that they feel like inflation is now under control and coming back down towards that 2% target that they have. And then you start to see the bond market, the prices go up or rates come down in the bond market. Good. So it's more tied to that. So it's not a one-to-one correlation where it's like the Fed drops 50 bips on the Fed funds rate or prime rate. It's more based on like the inflation readings. So sometimes it could be rates could go down before that even takes place as we start to see the inflation bottom out. Also, if you look back through history and if you look at charts of like recession, it's like are we going to go into recession? Are we not? You have a lot of that talk for next year. If we do go into recession, every single time in history over the last 100 years, every single time we've gone into recession, right afterwards, rates go down significantly without fail for the last 100 years.
Makes sense.
So if that happens, then it's a really clear indication that rates are going to be coming down. So, and housing typically does really well during recessionary times, except obviously in like 06, 07, where we had more of a housing recession, but in just general recessionary times, housing does really well. So it'll be interesting to see how next year plays out. So I have a couple rapid fire questions for you, and then we'll wrap up. So, what's your favorite hobby?
Golf.
I knew that. What do you shoot? Scratch.
Yes.
Yeah, good golfer right here. If you didn't know, do you still compete a little bit?
I do. I'm going Monday actually to a state tournament.
There you go.
Yep.
Love it.
Yep.
Favorite business book or podcast?
Reading a good one now on blockchain called the Truth Machine.
Oh, nice.
But I'm a Jordan Peterson fan.
Okay. Yeah.
Podcast.
Great author. Great podcast. If you could have lunch with one person, dead or alive, who would it be?
Clint Eastwood.
Yeah.
or maybe Ronald Reagan, but I'm a Clint Eastwood fan.
That'd be a fun lunch with Clint.
Never a dull moment.
Who inspires you?
My children.
Yeah, me too. One word that describes South Florida.
Paradise. No doubt.
Best business advice that you ever got?
That I didn't follow.
Yeah.
Just to keep your company manageable size and not get out over your skis. And I didn't always follow it, and I paid the price. I have in the past.
And favorite local restaurant?
Oh, Okeechobee Steakhouse.
Oh, yeah. Oldie and a goodie.
Mm-hmm.
Great spot. Charles, this was awesome today. I think there's a lot of good information. You're always a wealth of knowledge, and I just appreciate you and everything you do in our local community, and for us, and for the the homeowners out there. You provide a lot of value, And just want to thank you for coming in today.
Well, thank you for having me.